learn about this, the opportunity itself, and what it has to offer. And also just for you to, especially those who don't live in Houston, for you just know about the market itself and everything. So we're very excited and looking forward to sharing all the details with you. But before we do that, we want to at least for you to review the legal disclaimer, so at least we can both be on the same page from a legal point of view. Next slide. And we might have some technical difficulty with Tom's laptop. Tom, if you're having technical, do you want Raj to take over?
Yeah, Raj, can you take it over for now?
Yes, I'll take over. Yeah, close the presentation.
Sorry about that, guys. As you know, with life, there's always technical difficulties to make life normal. All right. So here's the legal disclaimer. So we'll go ahead and spend just 1 minute for you to review it. We'll be sending this documentation to you. So if you don't get time to read the whole thing, don't worry. We'll send you the entire slide deck so you can, take your time and go through it. All right, about Elan. So executive summary, Kendu-Bay Properties, ORP Investment, and our partners. We are partners on this deal that we've teamed up with to acquire this wonderful asset. I'm very, very fortunate, and I'm extremely grateful for all the partners that have come together for the acquisition of this asset, and we really hope you join us as part of that partnership on this adventure. This property is luxury mixed use, 297 units, retail, mixed use apartment with 8 retail spots, built in 2016 by Greystar and owned and managed by Greystar. Greystar is the largest property manager and the largest institutional owner in the entire country. They have over 700,000. And this was one of the flagship brands, Elan Memorial. As a matter of fact, it's a dedicated brand that the trademark that can be used anywhere else. Us as the sponsors, we have over 1,000 units in the Houston market. We look forward to sharing more details with you about us in the next few slides, but this is one of our bread and butter market in terms of a market that you can ask me a question and I can tell you okay, I know everything about that market because we just have so many assets in this market. We have very strong track record in Texas. We have everything from A to C classes. Some of our assets have been sold and we've made great return for our investors. And we look forward to this hopefully being one of the ones whereby after 32 months or less, we can turn around and sell it for a good profit to you. Houston market is a great, great, wonderful market with over 51 Fortune 1000 market. There's a lot to love about Houston for several reasons, being the location, being a major hub with low cost of living, low cost of doing business, accessibilities, and everybody love it. Everybody want to move to Houston just because of what it has to offer. A lot of companies have relocated there or have made a great expansion into the Houston market. And Raj will be sharing about all those great, wonderful stuff about Houston with you. So I think it's very important for you to know us, understand us, know what we stand for and what we try to do. And so this slide, we just want you to have a little bit of, understanding us from a philosophy and a principles point of view. Our philosophy is, with the plan of doubling your money in 5 years or less. Our goal is to acquire properties that are located in landlord-friendly states. You guys know, so during the COVID-19, how some states really mistreated landlords. I'm so glad they don't have any property in those markets. All along I've owned property in Texas. My property gave profits in the middle of COVID-19. And so we focus only on landlord-friendly market. It's a key requirement for us. And not only in landlord-friendly market, but we also focus only on the primary markets and secondary markets in those landlord-friendly markets. And that's extremely important because in order for us to come in aggressively execute our business plan and be able to double your money in 2 years, which means we have to have a really, really good tenant base, a really, really good base of employees that we can hire, good quality property management companies. The vendors have to be certain level of quality and a good number that we can bet on in order for us to execute really fast. So being in a primary market is extremely important. But also more important than just being in a primary market, also the market has to be and the market that has a job growth that's above the national average, population growth that is above the national average, and income growth that's above the national average. When we say we want to increase rent by X amount and we want to increase other income by X amount, the overall market fundamental has to be able to support that. We can't go and increase rent by $200 on a market where the economy is tanking. It won't work out. So we try to be very strategic in the market we select to work in. The sub-market has to be one of the best sub-markets in those targeted markets. So you look at it from a state level point of view, a market point of view, and a sub-market point of view. And it's very, very important that it meet our criteria. Our guiding principle is, to analyze investment with prudence, diligence, and care. One of the key things we must do is to make sure that before we present this offering to you, is that we've done the necessary diligence to make sure that everything is done correctly. For example, we've walked every single unit on this property so that by the time we present it to you, at least we can tell you, yes, we've walked it, we've known the condition of every unit, we know this is what is going to take to rehab the property, and this is what it's going to take. And if there's any red flag, we tell it to you as part of, being upfront with you so you can make an informed decision about these investments. As part of doing business, one of our principles is treating everybody with integrity and respect. This is a team sport. The investors and partners play a role, the tenants play a role, the vendor play a role, the property manager plays a role, the employees play a role. Everybody has a role to play on this sport, and everybody has to be recognized for what role they're playing. And therefore, everybody we deal with has to be handled with, respect and care. When you reach out to us, we gotta make sure that we attend to you, treat you with integrity and everything. And the same apply with the tenant, because remember, tenant is what's going to make you make the profit. So we got to make sure we treat them nice and butter them really, really well. Our value of proposal, if you look at it in this case, we have over 10 years experience running this type of property, doing real estate investments. We are over 2,000 units. Out of that 2,000 units, 2,000 units under asset management that we own. Out of that 2,000 units, we have about 1,000 that are located in the Houston metro. If you can say, where is our greatest strength? This market is where we have the greatest strength in terms of economies of scale, the expertise, the knowledge about the market, what works in the market and what does not work in the market, and makes it very, very easy for us to execute on our business plan. Of course, we have experience in owning everything from C class to A plus. So when you talk about running the asset, we've gone through that. We've gone through tough properties and made it through. And this, we're looking forward to using our experience to run this asset. Last but not least, one of our key focus is value as a function of experience and quality of life. And throughout this presentation, that's going to be a key driver. Remember, these are very affluent demographic that value a lot on experience. And what we're saying, if we're going to bring you 100% return on your money, we have to give them something in return, and we're looking forward to doing that. All right, a little bit about me. Jack Aduo, I'm based in Boise, Idaho. Been doing investment for over 10 years. I'm a full-time real estate investor. This is what I do. I live and do every day. So when I tell you we're going to take care of this deal, we're the partners that roll our sleeves and get to work and get it done. I go to Texas a lot. I was literally in Houston 2 weeks ago. I've been there a number of times this year. My partner Raj, of course, will talk more about himself. He's the local boots on the ground. Raj, I'll hand over to you, and you can take it from here.
Thank you, Jack. Thank you for a wonderful introduction. Firstly, I would like to thank all the audience for taking the time out to joining us. I know you could have spent your time with your family. We value your time, and I think you will like this presentation once we go through the returns and what we have to offer here. Similar background as Jack, 10 years plus in real estate, started with single family, then commercial, shopping centers, then a full cycle of 200 units. And then for last 4 or 5 years, we've been doing a syndication, and mostly with Jack. I had another property in Florida before I met Jack. So we've been buying mainly in Texas and Florida markets, and we'll continue to syndicate. This is, like Jack was mentioning, full 100% of the time. So we both left our W-2 last year. This is full attention to this business that we are in. So with that, I want to also thank our general partners and co-sponsors. Firstly, I want to thank Titan Core Capital. We have Mickey Lake and Sia. Mickey Lake is MD out of Florida, and Sia is MD out of California. They partnered together to form Titan Core. They own together as a co-GP, a GP, 970 units, 240 assets under management, and then they're going to be part of this journey as well. Then we have Nelson Lee. Nelson Lee, of course, Jack and I were part of Brad Samra Group, so we met Nelson there. He's been in many of our deals, and he's coming in as co-sponsor here. He's an entrepreneur by nature. He has a landscaping business, and he has over 2,000 plus doors, both as LP and GP and co-GP in multifamily. Not only that, he does storage units and other alternate investments. So he's an entrepreneur by nature. Then we have Valley Oaks Capital. We have Nicole and Brian, sister and brother, again from Brad Samra Group. Thanks for joining, guys, as well. They have over 2,000 doors, mainly in Arizona, Texas markets, but they're expanding their footprint as they're trying to grow into multifamily arena. Then we have Hari Rao. He's a recent inductee into Brad Samra Group. Hari is an entrepreneur by nature. He has an IT company, and then he has land deals. He has co-GP'd with other partners. He's coming in. He has co-GP'd with us in reserve at Eagle Landing. So he's coming in. We're excited that he's on board with this venture as well. Then let me introduce David Teo. David Teo and I we used to be part of a group where we started the commercial. We're part of a startup of a commercial side of things back in 2017. So very good friend of mine. His company is Marillion Investment. He does multifamily, Class A, Class B. He has done Class C in the past, but he's now focusing on Class A, like us. He does land deals. He has done office, medical offices, you name it. So this is also his full-time into real estate. He's starting a fund. So he's been there and done that, right? So last but not least, we have Tom Ajuo. He's part of Kendu-Bay. He's gonna be the investor relations. He's gonna monitor the subscription process. If you have any questions regarding that, he'll be able to help us navigate through that process. Thank you all. So coming to the assets owned by our team, right? So we'll start at the top. If you see the top two here, we have Cambria Co, which is Class A, and Augusta North Houston in Class A. Related to the map, it's in Spring. Then we have a portfolio of 2 apartments, Sun Prairie and Glen Oaks. We rebranded it as Reserve at Eagle Landing. And you can see that picture here. And then we have Seabrook, which is in NASA area. And then we have Live Oak, which is in Energy Corridor, which is here. And then we are acquiring Elan Memorial. So this is our present market. So we have 7 properties. This will be our 8th property in the market. So then why multifamily, right? So it's asset like no other. What I mean by that is it's a recession-resistant investment, so to speak. What that means is people need place to live. As you know, Houston is a growing market, population growth, job growth, income growth. So, and as the more and more millennials and retirees, right, coming into Houston, their preferred destination is multifamily. Things like Elan fits right the bill, right? So recession-resistant investment. So if nothing else, folks, you want to conserve your principal, okay? The hard-earned money, you want to conserve it. So you want to own asset-based investments. It's a good diversification as well. So safety and stability. So, and then consistent passive income. What I mean by that is earlier we used to call that a mail check money, but now it is like more like an ACH money. So every quarter, the cash on cash distribution goes out. You just you just record it in your bank, and you don't have to do much to get that consistent passive income, right? The biggest reasons why people coming into real estate is one of the reasons why people come into real estate is tax benefits. So there's a huge tax benefit. We'll talk about it. And then leverage money. So you are using other people's money to make money for yourself. What that means is, like, if the property is 100 million, 80 million comes through a loan, bank loan. Only you have to put in 20% down. So you're using other people's money to make money. So it's a leverage money. So that's the leverage returns. That's the power of leverage returns. Okay. Lastly, but not least, but inflation. As you know, we are living in inflationary world right now. So people, during inflation, want to hold on to hard assets. What I mean by that is gold, silver, physical gold, physical silver, land, real estate. These are the places where people are putting their money. And that's why it's a good diversification. That's why you want to highly look into multifamily. Then I'll just talk about a couple of points on this slide. One is, you can see there's the largest decline in permits. What that means is supply is going down while it's a second highest demand since start of pandemic. So this is a deadly combination which gives you annual growth, rent growth, which drives the rent growth. As you can see, 2021 is 10.2, 5.2, and 3.7. In our underwriting, as Jack will point out in later, we only use 2%. We don't go and get this forecasted rent growth. We are conservative in our approach. We only go for this. And then you can see the supply is going down. While demand is increasing, supply is going down, which puts an upward pressure in rent growth, okay? The key takeaway of this highlight is that there's a 30% reduction, 30% less supply of Class A, and Elan Memorial is Class A, right? So this part of asset is well received and is continue to do well in Houston, okay? The last thing I want to talk about in this slide is 55% rental rate increase since 2011. So that continues, because as Houston grows, the demand grows, supply is less, there's upward pressure in rent growth, okay? Here, I want to talk about 2 points. One is the growth, 15.6% over next 5 years in Houston. That's how many people are going to move into Houston, okay? and about 1.4 million have bachelor's degree or higher. Okay. And then you can look at it, this thing, income is also going up, which is at 5.4. The other two things I want to point out is top five. It's called City of Future, City of Future, but it's top five in North America. Okay, and then number one for young adults moving into Houston. Okay. Now, which are the biggest economic drivers? You know that Texas Medical Center by far is largest, and $3 billion worth of construction is underway, which adds $25 billion in annual GDP, adding 106,000 jobs. Okay, largest medical complex in the world. And then you have logistics, which is Port of Houston. As you know, as they expand the Panama Canal, super tankers are coming in. Guess which city hits first? Which large city hit first? Port of Houston. So Port of Houston by far is largest exporter of goods. What that means is it's a transportation and logistics jobs are coming into Houston. 131,000 jobs, and there are about 4,600 warehouse establishments in Houston. Of course, we have 2 international airports as well. Then, of course, Houston is well known for energy. So we have about 4,600 plus companies located here, $3.7 billion just in clean energy ventures being spent here, okay, which has created over 110,000 jobs. Now, the less known fact about Houston is digital technologies. Of course, Amazon Web Services is here. Of course, you heard about Google opening a cloud infrastructure sales unit. All in all, there are 500 plus digital tech companies in Houston, which is not well known, right? And then about 80 to 100 companies in tech industry, okay, adding about 28 billion economic impact, okay? So what this figure shows you is Houston is well diversified. It's not dependent upon any one sector like people think. So continuing this conversation, and you have seen that Space Center as SpaceX and other private companies are going and commercializing the space. There's a huge demand. Spaceport is being built. A spaceport company is calling NASA their headquarters. Near NASA, they're building their offices there. So in all, there's about $8 billion economic impact because of space, and then about 52,000 plus jobs. Then, of course, ConocoPhillips. ConocoPhillips has headquarters here. Adding to ConocoPhillips, ExxonMobil is relocating their headquarters from Irving, Texas to Houston in 2023. More jobs are coming in, more high-end jobs are coming into Houston. So again, as more and more companies come in, the growth is higher and higher, right? So then look at this manufacturing. Tenor is just one of the example, but we are number 2 in manufacturing in GDP. So about 83 billion goods are produced in Houston area, okay? 6,300 manufacturing firms. Of course, we talked about medicine. So Baylor Medicine College here. So like I said, Houston is not dependent on one single employment, okay? It is well diversified city, unlike most what people think. One key thing I want to point out here in the interest of time is Houston is proclaimed as most ethically diverse city, surpassing New York City. Okay, 1 in 4 are born or international, predominantly international city. Okay. Now let's talk about the Elan Memorial and the investment highlights here. So as we told, Elan is in a very posh neighborhood. So that means you have to give lots of amenities. So this property has lots of amenities. It has 24-hour fitness, high quality clubhouse, and then it has a yoga center, interactive exercise room, so on and so forth. Well designed and thought out floor plans. Okay. what I want to get you even more excited is the rent that we are getting in this is well below market comps. Jack is going to talk about that. And you can see the recent lease rents. We are getting 18% bumps in rent. Okay, so he's going to talk about that. And also, I want to point out about other income. So right now, there's a ton of potential other income that we can add, coupled with operational efficiencies and expense reduction. Jack is going to talk specific about this. And then it is very close to major employment hub. And one thing I want to point out, this property has ultra luxury mixed used asset. What that means is it has 8 retail space. Not only you are giving your tenants all these amenities, even like if you want to take a break from your work and go have a cup of coffee or have lunch, it's right there. It's all right by the property. People don't have to go that much far. So you are giving true experiential value add for your tenants. Okay. Now, what is the projected returns for Class A? Before I go to projected returns of Class A, we have divided into 2 classes. Class A, which is preferred returns, whatever the money left over from the operations, first goes to preferred returns, which is Class A. Class A is at 7% cash on cash. Okay. So whatever money is left over, we're going to first pay to Class A because they're getting first cut at this. So they're capped at 80%. So what that means is from cash on cash, they'll get for 5 years. If you had invested $100,000, you'll get $35,000 in cash on cash and $45,000 on profits on sale on top of your $100,000 investment. So you'll get 1.8x back, meaning if you put 100K, you'll get 180K back in year 5, after the sale. Okay, about 80% ROI. Then Class B is a little different. Whatever the money is left over is split between GP and LP. LP GP split here is 70-30. So whatever the money is left over in year 1, you can see it's only 1.6%, which is lower number. But as we increase the operational efficiencies and also increase the income, we are going to get again, 8% second year, 9%, so on and so forth. What it averaged to is about 9% cash on cash average, which is if you are putting $100,000, your cash on cash will be $46,327. And then your profits on sale is going to be $56,506, total adding up to $102,833. This is just your returns plus your 100,000. So you'll get 2.02x of the money you put in. Okay, so you're going to get 202,833 at the end of the sale. Okay, so these are the classes. And then the investment summary alone, this property is located in 920 Westcott Street. It has 297 units. Very good unit mixes. Jack is going to talk about that. And then 8 retail, and it was built in 2016. We are purchasing for $88.5 million. Total equity raise is going to be 25.3. Entry cap is 4 and exit is 5. Okay, the whole period is between 3 and 5. Then on the right hand side, return summary, we talked about this. So Class A is going to be 16% annualized returns, IRR of 13.8. And then Class B is split 70-30. It's going to be 16.5 IRR. You're going to double your money in 5 years. Okay. After 2.15x, the profit split changes to 50-50. Okay. And one thing that most people look for is this, which is 100% year 1 tax write-off due to cost tag and bonus depreciation. Okay. And then our equity sources. So our senior debt is going to be at 75% LTV, pref equity of 10%, and then common equity of 15%. I'm not going to read through this. We will have the slides for you. Important thing is we have assumed 4% interest in our underwriting. We are getting around 3.6 or so. This is a bridge loan, 311, 3 years interest only. We can extend for 2 more years. Jack is going to talk about, the refi plan and other things. With that, I'll let Jack excite you with the submarket and the property itself. Take it away, Jack.
All right, that much better. Can you hear me now?
Yes, we can hear you.
Wonderful. Thank you very much, Raj, for going over the Houston market and the returns. Folks, as you can see, there's just a lot to love about this asset in terms of the location, the property itself, the returns we're projecting. It used to be good old days that we say that you can only get good returns with the C class and B class asset. But I'll tell you one thing, if you dig deeper and a lot harder, you'll find this deal. So if you're into hunting and, looking for the golden nugget, this is one of them. And you're in luck. We're in luck on this one. So let's just talk about the submarket. I just want to say one thing. If you remember back our initial philosophy, right, which is focus on landlord-friendly markets, and then focus on markets that primary markets with good job base and employee base and vendors and tenant base. We got those checked. And now let's talk about the submarket where it is right now. So we're drilling down deeper, In this case, the Heights in Washington submarket, which is the submarket where this property is located. This is the most desirable address for Houston urban core. And it's very important. We talk about core. We're not talking about core plus. We're not talking about opportunistic. We're not talking about value add. Property of this class, the core, that is. This is the most desirable address. This property, for example, near this property, the 2 most prestigious private schools are in this submarket where this property is. And we'll go over those in the next few slides. This high-end apartment in this location, the average home price in this location is $1.9 million, which translates to about $4,000 of mortgage. You compare that to our, rent of, $2,000, you can see we have room to grow between what the rent is today versus somebody want to live in this area. They don't have much choice because there's no land available to begin with, where they can find affordable housing. Look at the submarket ranking. This for the core. Once again, we're talking only about the core. This is the best in the overall metro. This submarket is also the top 3 among the submarket with rental rate growth and absorption. One of the things I want to highlight in the submarket in 2020, the data came in from Costa. By the way, all this data came from Costa, Elan data, Yadi Metrics, and the broker. So that's where we got majority of our data. So this data, for example, that talks about the rental growth. Look at for the last 12 months in this submarket. In 2021, the rental growth was 23%. With us, we're not assuming we're going to achieve that. We're still going with this good old 2% year-over-year rent growth. And as I indicated in the previous slide, the 13 leases leading up to us acquiring this property, put in the contract, the property was experiencing 18% rent growth. So when you see this 23%, which means is in line, this property is in line with what's going on in the submarket. And just look at the supply versus the absorption. There's only over the last 12 months, there's only been 1,200 units supplied, and they need about $3,000. So more than double what they need, what the market needs. So there's just a great gap between what's available in the submarket and what's being delivered. Hence, the reason why the rents are growing like crazy in the submarket. I mean, look at those at the graphs. I won't go into this all in detail, but take a look at them. Just look at the bottom right, 2021. Compare the absorption versus what was delivered. It's just night and day difference between what's coming in on market versus what's available. So a lot to love about the Heights Washington submarket where this is. Great location, great location. Next slide. Okay, now the retail. Let's talk about the retail because as you guys know, this is a mixed use development, right? So downstairs, all the ground level is retail. We have 8 retail spots, and we'll talk about them later. But let's talk about the submarket for now. This is the Inner Loop River Oaks submarket from a retail point of view. This has some of the highest end signature retail destination in the submarket, which is reflective of the general location where it is, right? The 3-mile radius, or the 5-mile radius of this property, which should for the most cover the entire submarket, the median household income is about $140,000. So it's extremely affluent area. I just want to point out a few things. Look at what's delivered in the submarket from a retail point of view. In over the last 12 months, only 90,000 square feet of retail has been delivered, and the market needs about 180,000 units, or rather almost 200,000 units. So in other words, more than double what's delivered. Hence, another reason to indicate why the market itself is growing like crazy. As you can see there on the retail vacancy is 4% in 2021. On our underwriting, we're using 10% for the retail. We're going to basically assuming the entire time we're going to be holding property, there's going to be at least 10% physical vacancy. So we're giving ourselves really good wiggle room to grow in terms of retail vacancy on the property. Is just a little more about the location, right? Now, from a location overview, within the 3-mile radius, there's 170,000 people that live within 3-mile radius of the property. That's a lot of potential tenants. That's how I look at it. A lot of potential tenants, which means if you go into a market whereby you want a good supply of tenants, this is one of the places to be. But what's even more attractive than that? Because there has to be there has to be something that brings them to that location. Is the jobs. There's 180,000 jobs within the 3-mile radius. So if you compare, 170,000 people live there, and that 170,000 includes a lot of kids, right? People that cannot work, seniors that are retired, or the people that like in a household whereby somebody's watching the kid and the person is working. So there's just a good supply of jobs within the 3-mile radius to support the demographic that live here. Also, another thing to point out, 20,000 employers within 3-mile radius. That's really big. You have 20,000 employers within the 3-mile radius. So you talk about, who's going to generate those jobs for them. There's a really, really good supply of employers in that area that will be able to support that. Just want to point out again, the median household income is there within 1 mile and 3 miles. You can see 3 miles, $142,000. Average home price $1.9 million sold, and mortgage about $4,000 per month. Next. More about the retail, as Raj indicated, more about the location, as Raj indicated, a lot of these destinations are less than 15 minutes from the property. And by that, I mean it's only 4 miles away or 5 miles away. Take a look, for example, downtown, 4 miles away. The Texas Medical Center, as Raj indicated, the largest medical center in the entire country, the 8th largest district, business district in the entire country. Over 55 different institutions live there or work there, and over $25 billion to just the local economy. This is just less than only 7 miles away from the property. Elan Memorial Hospital is only 4 miles from the property. So there's a lot of destination, both from work, entertainment, everything you need that are just within a few minutes away from the property. As indicated, with this type of location, the sub-market we just spoke about, we being one of the most, the sub-market, retail sub-market with very high-end retail outlets and retailers. This is just reflective of it. Look at it. Within 3 mile radius, we have 18 million square feet of retail spaces. Pretty much everybody you need is there within the 3 mile radius. Really good high end, to normal just day-to-day life retailers, all within short driving distance from the property. The tenants don't have to go anywhere far, as you can see based on some of the brands we have here that are just a few minutes from the property. Memorial Park, the namesake of this property. Let's talk about recreation and entertainment. You want a place with a great recreation and entertainment, this is the place to be. This property is one of the only 3 properties in the entire Houston Metro with a true walkability access to Memorial Park. Other properties will say have the same name as Memorial Park, but in order for you to go to Memorial Park, you kind of have to drive there. You can't walk there, or you have to ride a bike there or something. But this property is literally you can walk to the park. It's one of the 3 ones. And when you talk about Memorial Park, this park is the largest urban park in the entire country. Over 1,400 square feet of acres, and it's twice the size of Central Park. Think about it from that point of view. A lot of activities are happening in this park. There's 30 miles of biking. So if you like biking, this is the place for you because there's just all the space you need to bike every day. The park is worth over $1 billion. There's something for everybody. You want to go, golfing, this is the place to go. As a matter of fact, the PGA Tour in Houston, this way they have it. Every year, there's 60,000, I think it was 60,000 golf rounds that are being played on this property every year. You think about it. You get tennis, hiking, whatever you need is all at the Memorial Park. And knowing that is only walking distance from the property makes the property extremely attractive to local tenants. As you can tell, we have 19 museums within this 5-mile radius. All the sports and entertainment within less than 10 miles for the most part away from the property. Everything that the tenants need are all in this place. Here's more overview about the property. I won't go through this in details, but just want to highlight it. So we'll be sharing with you so you can learn more about it. About the retail, so all the downstairs levels, except the leasing office and the clubhouse and everything, for the most part, most of the downstairs level are retail. Really good high-end retailers. As you can see here, based on our rent, we're charging well below the rent, that our comps, but in this case, mixed-use comps are charging in the market. We have room to grow in rent. Unfortunately, with the retailers, you're locked in for 5 years, but which means when they come for renewal, we definitely will be able to, charge something higher than what we're getting today. Here's some of the amenities. We can't, one of the things I would highly recommend is you go to the property website and see the amenities for themselves, because this presentation, we're not doing a full justice to all the amenities that the property provides. So we're just highlighting some of them. For example, the rooftop, lounge. The rooftop lounge is one of the premium attractions of this property. The tenant can go there anytime, sit out on the rooftop. They can have, host a party, birthday party, whatever they need to do. There's a grill station there, fireplace, nice lounge with the TVs and everything. They can enjoy the skyline view at night and just have just this breathtaking view of the city anytime of the day they want. Or once they're done on the rooftop, they want to head out to the park, they just go downstairs. As you can see by the bike place, there's just it's a very active tenant base by just looking at the number of bikes we have there. And this picture is not showing all the bikes on the property. As a matter of fact, we're thinking about charging for the bikes, but we're like, no, we won't charge for that. That'll be one of the free amenities that, tenants enjoy. But just very active. One of the things I want to point out, look at the day-to-day life of a resident in this property. On any single day, say on a Friday, you want to go on a formal date with your significant other, there's just a restaurant downstairs. Walk downstairs there to Union Kitchen, really good restaurant, have a formal date. Or, Saturday morning, you want to go get your nails done. There's a really nice high-end nail salon downstairs that you can go to. Or what about on a Thursday evening, you want to get your hair cut before you go hang out with your friends or go attend a game? Well, there's a really nice, good barber shop downstairs to take care of you. What if you've been working the entire day and you're tired of being inside your room and you want to just go somewhere where you can see other human beings, right? Hey, there's a nice coffee shop downstairs. Just go grab a coffee there, relax a little bit, and when the sun is setting, walk to the park, enjoy some nature, and then walk back home, maybe grab a beer at the Union Kitchen on your way back to the unit. So everything you need, you don't need a car, you don't need anything, it's all within there. And that's what makes this property extremely, extremely attractive. Here's more pictures about the property. So, I'll talk a lot about the properties. I won't go into this in more detail. I just want to highlight a few things in this area. We all know it's a lot of amenities and everything. The walk score is 73% compared to Houston of 40%. So it's almost double the walk score. Everything you need is walking distance from the property. As we indicated before, rent growth 18%. The last 13 months, the 13 leases, actual 13 leases before, the property was brought for sale. The average income being 166. Think about it. The average rent right now is about $2,000, which means on a year, the tenant is paying $25,000 per year on rent. So you compare that to $166,000, which means they're basically, that's 7 times what they're earning today. Rent is 7 times, they're earning 7 times what they're paying for rent. So if we're to increase the rent by $50, $100, whatever it is, it's not going to make a big dent to what they're earning. Very nice affluent, demographic. Business plan. So this is the most important slide of all the slides. This is where we tell you what we're going to do with this property. Yes, this property has met our criteria, back to what we said earlier, right? Location, right? Definitely with everything we need. It has to, now that we've acquired it, or we've been fortunate to put it under contract, what are we going to do with this property over the next 5 years? This is where we tell you how we're going to turn your $100,000 investment into $200,000. What will it take? Here's a summary of what that will take from a business plan point of view. With us, we're rolling our sleeves. We're going to be executing on all this from day one. Revenue generation, which is one of the business plans. Our goal is to bring rent to market rate. Some of the rents are below market rate, and we'll show you those on some of the rent comps. Bring the rent to market rate, ban loss to lease, remove some of the discount that they're currently giving, for example, to, staff. As I indicated, this one of the largest, owners is the largest property owner in the entire country. So there are some of the staff living at the property at a discounted rate. Those are corporate employees. We don't even need them to leave. We want them to live there, but they just need to pay the market rate. So remove those unnecessary discounts. Other income, which is one of the biggest selling points in this case. There are several ways to approach other income. One of them is to add fees that they're not charging today. Believe it or not, they're not charging amenity fee today, which is a little surprising considering the location, considering the fact that this is one of the premium flagship brands of the seller, that they've trademarked. Nobody else can use this brand. And part of the reason why we're keeping them is so that we can keep that brand, because there's some tenant base that, when they see that brand, they know it comes with certain level of quality. But anyway, back to business plan. Amenity, for example. Amenities here as an example. This property is not charging for that. And our goal is to come in, back to what we said on our first slide of value and proposal, which was, value as a function of experience and quality of life. So one of the things we're going to be doing is, in exchange for improving their lifestyle and everything, we're going to be charging certain things, like amenity fee. It's only $20. It's not that much. To a tenant, a tenant who's earning, like say $100,000, for example, $20 is not going to kill them. But to us, that $20 translates into 20 times $297 times 12 months. All of a sudden, you talk about $70,000 increase in other income, just like that. It's not a big increase on their rent. It's not a big, even if they just maintain the same rent, by us increasing that other income, all of a sudden we're making good chunk of change. So there's a number of other income that they're not charging today that we've reviewed with the property manager that we plan on executing on from day one. And by the way, just to be clear here, a number of these things we're already doing in our properties in Houston. So a number of these things are not new ideas for us. We're just planning on rinse and repeat on whatever we were doing in other properties. And for example, the other income whereby we increase the things that they're already paying today, but they're not paying what they should be. A good example is valet trust, right? Valet trust is an example. Our other properties in Houston, we're charging $35. Similar properties in Houston, we're charging $35. Some of those properties are not in as good location as this property, and they're not as premium as this property. And so if we can just increase that by $10, right now they're getting $20, we're just going to increase $35. Not a big increase, but that $35 all of a sudden is over $30,000 increase in income per year. You go multiply that with a 5 reversion cap rate. You can imagine how all of a sudden the property value has increased. So there's just a lot of other income areas that we plan on executing on. We're going to be promoting on certain things that they're not being aggressive on today that we plan on executing. In overall, we're going to have a rent increase of about 8% and about 20% in other income. We're going to be aggressively trying to lease the one vacant retail spot that not yet leased. On our underwriting, we assume it's going to stay empty the entire time, just to be conservative. But in reality, we're going to try to do everything to lease it up as soon as possible. Exterior and interior improvement. Our goal is to come in and improve the quality and the experience of the tenants. So there's certain things we have to do. If we're going to charge them $20 in amenity fee, come on, we got to give them something in return, right? One of the things, for example, is painting, which is probably going to be the largest capex on this project. We're going to paint the entire exterior. The pool area, the dog amenities. A lot of these things are well maintained and nice. We're just going to, increase it up a notch. We have to show tenants that we're doing something in return. That the new ownership is taking care of them even better than the previous one. Tenant engagement activity. We're going to be very, very aggressive with tenant engagement activity. Every other week, we'll be having some kind of tenant engagement activity. Very critical, from cooking lesson to whatever they want to do. For example, one of the things we're planning on doing is coordinating with the local restaurant downstairs. So one of the days, the local restaurant come just serve the food. We'll have some kind of marketing promotion for that. Operational improvement and other expense reduction. In overall, we plan on reducing expense by over 15%. Some of those, for example, are going to be coming from payroll. I give an example. Right now, payroll, they're paying $2,300 per unit. We've negotiated down to $1,500 per unit. We've gone over with the property management company. They come with the proposal, which means $1,500 a unit. They have full confidence we'll be able to achieve that. And so just by that, that's over 35% reduction. Property management fee, just by reducing it from 3% to 2%, all of a sudden we're saving $70,000 in property management fees. Renegotiating with vendors. A common example I like to give is valet trust. On this property, the valet trust is charging about $10. Well, we know on our other properties, we've negotiated with them to charge about $7. So just by that, renegotiating that, yes, $3 doesn't sound like a lot of money, but hey, you multiply that with $297 times 12 months, I think you're talking about a small chunk of change. And then, you throw in a 5% reversion cap rate, now you will be talking. So there's just several things we'll be doing to reduce the expenses that in turn help in bottom line. I like to give valet trust because it's a good example because we're going to be reducing on how much we're charging the vendor is charging, while on the other side, we will increase how much we're charging to tenants. So right now it's about $10, $15 that they're getting. When we take off, it's going to be about $20. About $25 increase that we'll be making out of it. So really good returns. When it comes to exit, our goal is to exit, your option one, refinance the property as soon as the 1 year is over, as soon as the lockout period over, so that we can cash out refinance, buy out the pref equity, guys, and us, the LP, keep the money and all the juice that's left with the fact that, at least we bought out the pref equity. Or if the money come out, buy pretty much, cash out everything. The option two is, try to sell it in 2 to 3 years. If we cannot cash it, do a cash out refinance. Or option C, if we want to stop fight, then just hold it for the entire 5 years. That's enough in a summary about our business plan. Of course, we have 1 hour. I can't go over it in more detail, but please, please, please feel free to give us a call. We'll be glad to go through this in more details with you and explain our entire business plan with you for the next 5 years. Next slide. Is more comps about rent comps. I won't go through this in details due to lack of time, but right, let's just go next slide. And for the 2-bedroom, and I just want to point a few things here. I want you to take a close attention to that place where Raj is highlighting, that 1,300 square foot 2-bedroom unit. That's a comp. So all in that section, we are comparing our 1,300 square foot unit with our comps that are 1,300 square foot unit, as you can see there on the square foot column. All these comps are in the same area, 2-mile radius. But I want you to take a close look at that, the top performer in that comp, Westcott. Westcott is literally across the street from us. This property is across the street from us. The same drive-by traffic that comes to us is also going to Westcott. It's the basically same square foot. As you can see, as a matter of fact, they're even smaller. They're 1,321 square foot, with us with 1,342. But hey, look at what they're getting today. They're getting over $2,000 above what we're getting. It's literally across the street from us. Yes, the only difference between it and us is 5 years newer, so big deal. But is that what $2,000 difference between what they're getting versus what we're getting? And it's not like we don't have amenities. We are also amenity rich. We have every kind of amenity that they have. And so when you look at that, you're like, wait a minute, there's room to grow. And as you can see on our underwriting, we're not saying we're gonna achieve 4,800 on our pro forma. We don't want to be, we don't know what they're doing, but we know they're doing something really, really good that we need to do too. So we need to figure out, once we acquire the property in more detail, exactly what are they doing so we can achieve that. But I just want to point that as an example. If you go through this rent com in more detail, you see that pattern pretty much throughout. There's certain top performers in the market, and a good number of them like half a mile away. But remember, one thing, we have the access, the location. We have better location than some of them. And so there's a lot, room to grow in terms of where we think we can push the rent to. Let's go to the next one. This more sales comp, I won't go through this in detail for the sake of time, but as you can see here on the sales comp, there's indeed a big gap between what property sold for in that end and what we're getting for. A reason to believe that we can achieve higher sales price in terms of price per unit and price per square foot. Is more unit mix. I won't go through this in detail, right? Let's just skip to the next one. We'll all share this in more details. Next slide. So I just want to spend 30 seconds on this just to highlight the 5-year cash flow analysis. We want to point a few things. Our underwriting, so as you can tell, one thing, as you can tell, there was 18% rent growth, right? On our underwriting, as you can see, we're using 3% year 1, year 2, and then all the years after that we're using 2%. We're not being ahead of ourselves. Look at the retail income. The retail is 493, 577, because the reason why we're going 577 because of the new lease that's starting in July of this year. One thing we want to point out is that even though they're starting in July of this year, we're not accounting for them this year. We're assuming that they'll start paying next year. So which means when they start in July, from July to December, that income coming from them is not factored into this underwriting. which means there's just more, more room to grow. Look at the reversion versus the entry cap rate, 100 basis points. I've seen some people, do even, 4.5 on 80% in the Texas market. So when talk about reversion, I think we're being extremely conservative with our reversion cap rate. It's very, very important to, to notice that. And our break-even occupancy is 60%, which means this property can go down all the way to 60%, and we'll still keep the light on and pay the bills. We want to make sure you know that. We're buying at 90s, the entire market is 90s. During COVID-19, they never fell below 90s. No, they went to 89, I believe, one of the times. But hey, they never went below mid-80s, give or take, whatever it was, right? So it always stays strong. But again, that's because people are moving to this market like crazy. They just know enough space, consider the location. Next slide.
Yeah, thank you, Jack.
Mm-hmm.
Yeah, one last thing I want to point out, even the retail income is not increased, throughout the next 5 years. We kept it at that, even though we have rent bumps in the lease, we have not changed. With that, I'll talk about the fees and other things. Thank you, Jack, for the wonderful presentation.
Yes.
So the property management fee, as Jack mentioned, was reduced from 3 to 2%, which is significant. And asset management fee is going to be at 2%. Acquisition fee, normally we charge 2%, but we're charging 1% here. And then capital event fee is 0.5%. And there's no other fees after that. Now, as we go through this is just a recap why we are excited about this deal. Okay, one, we have the ROI, which is if you choose to go the safer route, which is Class A, you're getting 1.8x. If you go for the traditional waterfall, which is what I like to invest, is 2 times at least. You're going to double your money. The second thing, what we talked about, as we say in real estate, location. So this is a core Class A plus property in a great location. Okay. And the other thing, what we are excited about is the rents. Rents are below market comps. And as Jack was mentioned, 18% rent bumps they are getting. Of course, we did not include that kind of in our underwriting. We are very conservative. And also potential 100K plus in other income potential. Okay. Of course, you saw the conservative underwriting, which is 20% economic loss in year one. And also you saw a reversion cap rate of 100 basis point. And also you saw the break even at 60%, right? So all those make a very conservative underwriting. Then the demographic itself, 1 mile radius is 166,000. This very affluent demographics here, okay? And then we are talking about Greystar, which is a very reputable, #1 in the country, reputable property management company, very strong record. And then our management team, our sponsorship team, we've been in real estate for 10 years, and Houston is our bread and butter. We own 1,000 plus units, so we continue to call Houston our home. So I'm boots on the ground, so I see these properties every day. So very experienced sponsorship team. And then the key figure here is 100% tax write-off, right? And then we talked about reversion cap rate. So what's the investment timeline? So PSA was executed on 23rd, due diligence completed on 29th. So today is the webinar. We will send you the link, the recording link, in case you missed it. You want to rehash any of the points, you can call us. You have our numbers. Then the subscription gets started, and then closing by May 20th. So what's the step one? Step one is we will send the webinar recording along with the subscription, the link to subscription docs. Then you review and have any questions, call your sponsors, have all your questions answered, and then subscribe to it. Once it's subscribed, we will verify. Once its verification is completed, we'll send you the wire instructions, and then you wire the funds. It's first come, first serve basis only. With that, Jack Ajuo. He's principal at Kendu-Bay property. His number and his website is given here. I'm Raj, and I'm president of ORP. So my number is given here. You can call us anytime. We'll be more than happy to answer any of the questions you might have. With that, we'll go to question and answer. Tom?
Yeah, ladies and gentlemen, thank you very much for staying with us throughout this presentation. We're going to open it up for question and answers. If you can go ahead and type your question in the question answers position, and then I'll have the principals answer those questions. So we'll open it up for your questions and we'll take it from there. Thanks again, once again. Thanks again for staying with us.
I think one of the questions, Tom, was, is 3 to 5 year hold period applies to Class A and Class B? So let me answer on that. Class A, your total, if you had invested 100K, your total investment in this whole thing is going to be 180K. So whenever you hit that, that's when you exit your investment, I guess. Hopefully I answered that question.
Yeah, and one of the questions that we have is, why is the seller selling?
Okay, so typically, like how we have our business plan, once we meet our business plan, which is to double investors' money, we exit the property and look for other opportunities. I'm sure it's something similar. They constructed this property in 2016, and it's now time to recoup some of the money in.
All right. The next question is 5.5% of total investment. Are those fees deducted from the returns? I'm assuming the 5.5 is the addition of all the fees that were listed.
I don't think I understand the question.
So
say that again, Tom.
So there is 2% asset management. There's 2% something else, and then there was 1% for the acquisition.
Right.
And then there's a half. Are those fees deducted from the returns?
So when we're telling you that you're gonna get your returns, those fees have already been deducted. So when we say 7% pref, whatever it is, yeah, those are already been accounted for. You don't have to worry about your return being reduced again.
So for Class A, which is projected for 80%, they will get 80%. There will not be additional fees deducted from that. I hope that clarifies that question.
That's correct. Yes.
The next question is, when do you expect to start distribution? Will they do monthly or quarterly?
We do
quarterly, and usually. Go ahead, right?
Go ahead.
It will be quarterly, and usually we start 4 to 6 months after takeover. Could be sooner. Most of our properties, we've been able to get it sooner. I know, for example, one we closed in October. We started sending it about 3-4 months into that deal. But I would say you should set the expectation of 6 months. Just to be safe. You take time for the, as you take over, get everything onboarded and hit the ground running. And usually the first few months, there's a lot of moving pieces. So it could be up to 6 months, but our goal is to get it to you sooner than that.
All right. I believe this question is, what's the minimum investment for Class B shares?
Class B in minimum investment is 50,000. Class A is 75,000.
All right. The next question is, why is Class A trading or selling at a 4% cap rate? Seems like a relatively good deal.
Why is selling at a 4% cap rate? What do you mean?
Yeah. Why is the asset selling or being sold at a 4% cap rate?
So that's the incoming cap rate.
Yes. Yes. So the entry cap rate.
Yes.
It's one of those things. Indeed, a lot of deals that are trading in Houston are below 3. As a matter of fact, one of the properties we bought last year was 80 asset, and we got it for 3%. Kind of what I said, you look deeper, you're going to find a good deal. Sometimes they're there, and surprisingly, even from, the big guys like the seller in this case, we just saw the opportunity. And, part of it also just the fact that, the numbers have just been moving so quick that, from the time everything started to now, the property performance has gone really, really significant. I'll give you an example. For example, the property we closed last year in October, from the time we signed the contract, but to the time we closed, the property income had increased by $100,000. So the market is quickly moving. I'm assuming if you were to go back when they first spoke with the broker, it was a lower cap rate, but just because the number continues to get better, we get lucky. And in my opinion, that's just part of being aggressive and in terms of searching for those golden opportunities. And we get lucky on this one.
Yeah, the next question is on the cap rate as well. They're wondering, what's the worst that can happen with regards to the market condition, and whether the 100% basis point is it, or it can be worse than that. What are some of the market conditions that might make that even worse?
Yes, so indeed, it would likely affect the sale. And remember one thing, that would affect the equity. So, but I would assume, assume you hold it for the entire 5 years, and hey, you keep getting a 7% cash on cash, you'll still be, doing pretty well, when all is said and done. I doubt, considering the way the market keep compressing, even if we were to go to the soft patch, I doubt it will go anywhere above 5%. But hey, let's assume it goes above 5%, which is a very possibility. That probably, bring you down to 90% total return or 80% total return. But hey, that's still a good return, considering, investing the same money in stock market or anything else. But what's even more attractive, and part of the reason why we love this asset, is that, look at 2021, how this market did in 2021. 2021 was basically still made of COVID-19. And if the rent growth was 23% in 2021, and they only delivered 1,200 units while the demand was 3,000 units, for sure people moving to town. And as long as there's a short supply and there's a higher demand of people moving to town, I just don't see it going down. Yes, it might go down. There's a possibility. As a matter of fact, you should decide, assuming that it might go down, but it can only go down after a certain level. In my opinion, yes, that's a possibility, but I just don't see it being a major issue. In my opinion, maybe, it goes to 5.25, which means you're going to make good money out of it. And remember, we're also giving ourselves a lot of wiggle room. For example, we're assuming we're not going to rent entire retail space for the entire holding period. We're assuming extremely high economic vacancy just to be safe. So we're putting a lot of mechanisms here and there just to make sure that, if one fails, something else works. Just so that, we can still be able to hit the same target.
And this one is, how many investors are you looking at to be able to close this deal?
So,
well, it just depends on how many big checks we get. It could be 10, could be 20, could be 100. Last deal we closed in October, right? I don't remember how many we had. I think we had, 70, you would take?
68, yeah, close to
it. Just depends on how many. We like to have some few people that are going to write, $500,000 check or write $300 check. And this time I write, say $300 check, all of a sudden, that's 6 people reduced by 6 people. Just depend on, a few that are going to write big check that's going to reduce that.
All right. And how often do you plan to communicate on the status of the deal?
Every single month. Mm-hmm. Go ahead, right?
Good.
What are the stress
every
testing
month.
analysis
Just
was?
just to let's provide a little more color on that. Every single month, you're going to be getting a monthly report, very detailed report. It's going to show you at least two pieces of information. The financial standing of the property, basically the T12 showing you all the expenses that we paid that month, what we collect in rent, what we collect in other income, everything. In addition to that, you'll also be getting, a summary of all the projects we've been working on or that we've done during that entire month. So every single month you'll be getting that. You will also get access to Juniper Square, which is basically the software we're going to be using to manage the investors. So at any time, at any day of the week, you can log into your portal and review those financial reports. So we're going to email it to you, but say you don't get it or you mistaken delete or something and you want to refer to it 3 months later, you'll always go to your portal and you'll be able to get all the historical financials for the entire property for the entire holding period.
Yeah, just to add to that, you also have our numbers. If you have any questions regarding anything, you can more than welcome to call us. We'll be more than glad to provide you the answers that you're looking for.
The next ones you guys shared that the property was COVID stress tested, and where this customer is wondering what are the stress testing analyses were done on the deal.
So, like I've mentioned, the one thing is you see we assumed that there's no increase in year one, right? There's no increase none whatsoever, and then we had a economic loss of 20%, and then on top of it, we are not using the seventh tenant that's coming on board in July, not using that revenue, and then the break-even analysis is coming at 60%. These are some of the parameters we use to say this is stress test. And,
right.
and assuming that, when the COVID actually occurred, what the property was, right? It's 80 plus occupancy at that time, right? So even with that, if you go to break-even analysis, it's at 60%.
All right. Do you have to be an accredited investor to invest in this deal?
No, you don't have to be. There are about 30 plus slots for sophisticated investors.
And what happens if inflation increases and you cannot sell at the price you intended? What will the IRR be?
So
that will depend.
Go ahead.
Go ahead, Rod.
No, go ahead, yeah.
Well, the IRR depend on that at the time we sell it, right? It could be, the 16%, for example, IRR we're saying is based on the 5-year hold period. So in other words, if you sell it sooner than that, then which means you're like going to be significantly higher. Indeed, if inflation is a potential, that's very true. But you look at it in terms of the entire 5-year holding period. And, remember they always say that, for real estate, inflation is really good because, the property values goes high, right? And so I think inflation is one of those areas whereby they say, from a real estate point of view, it's more or less a benefit than anything else because all of a sudden it's probably going to work significantly more as a result of that, than, if we don't. Remember, because inflation increases doesn't mean we have to sell it for less. We'll have to sell it for a lot higher than that, higher than, what we had even projected.
Just to add to what Jack just said, right? Just imagine if the inflation is higher than what is expected. What's going to happen is your income, people's income goes up, okay? And then your rents will go up as well. Because as inflation goes up, less and less people can afford single family homes. So they'll be moving more and more into multifamily, which puts an upward pressure into rent. So as inflation goes up, the rents go up and the income of the people goes up. Okay. Now, of course, the interest rate goes up, right? But given the rents keep going up in the inflationary environment, right? You're cash flowing really well, right? We as a group, we can decide whether we want to sell at the price we are getting, what are we getting at that point, or continue with the cash flow. So it's going to be even better cash flow for us in the inflationary environment.
Yeah. And also keep in mind, remember, right now the average home price in this area is $1.9 million. Which means I think that was what, $4,000 average mortgage or whatever. I think $4,000 sounds really low, but I think it's 1.9 right now, the average home price. Which means if you think about it, if they're going to become even way more expensive than they are today, and which means people will be flocking to us to rent. This one of the good thing about this place that there's very limited or no land developing at all. So anybody want to get that experience of Memorial Park, among other things, that's never choice. It's like, living in San Francisco, like you're sandwiched, between the water that, the price can only go high. And this, in my opinion, this is one of those locations. It's not like San Francisco, but I'm just giving it as an analogy to show how much there's not much space to grow in this submarket.
Yeah, just to answer that question, right? 1.9 million would be around 6,000 to 9,000. That's your outflow of mortgage.
Oh yeah. So you think about $6,000 versus $2,000 they're paying today, which means they didn't want to afford $6,000 from now if they cannot afford $2,000 right now. But if they can afford $6,000, which means, and that goes $9,000, which means $2,000 might be very attractive for them, and they might consider, coming to a $2,000 rent instead. Or hopefully by that time we'll be charging $3,000. That's my hope, because some people are getting $5,000, and that's across the street from us. So hey, we need to think twice what we can do here.
And what is the current occupancy?
97.
With the mid-90s.
Yeah.
Go ahead.
It's about 90, 95 plus.
All right. Do you have any big private equity partners?
We always.
We are talking to
go ahead.
a few, none we've signed yet, any agreement with yet. We're talking with our goal is to get the best offer, with the best terms. So nothing is on the table yet that, we say we locked to work with at this point.
Just to add to what Jack said, right? The good thing about bringing those guys, they take less. They take like 1.3, 1.4x multiple, which means the cash pool even gets bigger, right? So think in that terms.
Do we need to invest as LLC or as an individual?
This is more of their tax question. They can come in as LLC or they can do individual. It's more like their CPA, what they're going to suggest. I would highly recommend for them to talk to their CPA and get the answer that way. We can take either way. For us, it's not an issue.
All right. Is your plan entirely reliant on being able to refi? That's because interest rates are continuing to rise.
Well, that's why we get to, yes, that's the option A. But I see, as a matter of fact, that option A is not even the underwriting. The underwriting is in option B, which is basically sell. Rather option C. The underwriting is based on option C, which is holding for the entire 5 years period and then selling at the end of the 5-year period. Option 1 is refinance. Option 2 is sell it in 2 to 3 years. Option 3 is sell it at the end of the 5-year period. So our underwriting is not based on us being able to.
Yeah, just look at
not heavily relying on us to refinance.
Yeah, just look at the business plan, exit strategy column, right? So it is all these 3 options are listed.
All right, we're going to be winding down on the last couple of questions. Please recap for us the next steps.
Yeah, like the slide was saying, we'll send out a webinar link, meaning the recording of this webinar, and then we'll send you the subscription doc link, right? You'll be able to subscribe the document. Once you subscribe it, we will verify your information. If everything looks good, we will approve your process, subscription process. Then we'll send you information to wire the money, and then you will wire the money, and then it's first come, first basis.
How much are the sponsored investing?
So we are required. Go ahead, Jeff.
The requirement is at least the minimum. Will for sure invest well above the minimum. At least me and Raj for sure will definitely invest well above the minimum. But the expectation is at least each of the general partner to invest at least the minimum.
Our last question is Class A versus B investor determined by the amount invested?
Can you repeat that question?
Yes, what is it?
Is Class A versus B investor determined by the amount invested?
No, they select which option they want. We just have a minimum investment, but you can be you can just whatever minimum for that class is what you go with. Also, just want to point out we also have the hybrid, right? Whatever amount, say you have $100,000, you can split in half, whereby half of that $100,000 is class A and half of it is in class B.
Yeah. So some people have hybrid, Tom, in our previous investment. So they can do 50% in class A and 50% in class B or whatever,
Okay.
Hybrid model.
All right. I want to once again thank all the attendees, the ones that are still with us. We do encourage you to reach out to your sponsor and or the principals with any additional questions that you might have. And we're looking forward to all of you guys joining us on this great investment in a great location, Class A property. And we are truly honored that you're able to make the time to participate in this webinar. Thank you guys very much.
Yeah, thank you. If there's any other questions, Tom, let's capture and send the information to the requested parties. So
yes.
Yes.
Yeah, also just want to say thanks, guys. Thank you so much for spending the evening with us. I really, really hope, at the end of this, you learn a lot from us. You get to know us. You get to know the property. You get to know about the location. And I'm really hoping you can join us on this adventure for the next 5 years. It's going to be a great adventure. It'll be great to have you partner up with us so we can, make a little extra change out of this deal.
Yes, thank you. Thank you so much.
Good night.